Good evening. Ira Epstein of Linn Associates with your financial market wrap-up, and this is for Monday, the 20th of July, 2020, about 5:45 p.m. Central Time. I'm out of the hospital, got out this weekend. My leg is killing me, so I'm probably a little crooked on you here as I'm favoring one leg. Got stitched up all over the place to get rid of the problem that I had, and they claim it'll be fine in a couple of weeks, so we'll do what we have to do. I didn't miss a beat if you're a subscriber to my research. Every day I put out my morning subscriber video and my evening one. I might have missed it, my day of surgery on the evening Spider ETF video. I'm pretty sure I caught it in the morning before I got operated on, and afterwards you can imagine you're not doing the best. But stayed in there a few days. People were wonderful. Masks galore. Family cannot visit you at the hospital I was in, so you're really all by yourself for 5-6 days. And that's how long I was in there, but I still got my research out, and I'm on top of the markets. I didn't miss a beat. What was I going to do? Lay in a hospital bed and watch TV? If you know me, that's not what I exactly do. So where are we? Well, we know that we have a tale of two cities. We know that anything that is a mega cap tech stock is off to the races. We know that the old world stocks, the U.S. Steel, the Ford, and all those, they're in trouble. In the commodity markets, what we've looked at is the market is anticipating that this new world will have a demand for base metals. Base metal supplies are being cut a little bit because in Peru and Chile, you're getting COVID-19 and the miners don't want to mine as much. I can't say that I blame them. That impacted, I think, the silver today, but it's just one of many stories. The economy isn't shutting down everywhere, but it's happening. In Chicago, they just announced a new mandate. Restaurants, parties, no parties of beyond 6, no party of beyond 6. Everything's changing again because our numbers are going back up. So it's getting ugly. We've seen that in Texas, California, Florida. I can go on and on. The stories are ugly. So let's take a look, if we could, at the S&P. The market has not gone for the new high of 33.81. That was the high that we had before the crash, but it certainly made back everything. And I feel good when I came out in April, right at the beginning of May, and I said, folks, I don't want to be caught left behind like I was in 2009-10 when this market bottomed, and you kept questioning, is that a real bottom? I said, anticipate it is, and back in this zone, you all know that I switched my gears via the chart action, the bullish. Now the market has now, as I've taken a look at this, we were in a correction mode with lower highs, lower lows. You came out of that on July 10th, and you are right now a bit higher than that on the 17th. So we now know that that correction phase ended. The question is, where are we going? And this is a weekly area chart of just closes. When we look at a daily bar chart, well, we're pushing the highs of the market. What else? Before I left, I said this was your resistance zone. In fact, this is about where it was. We'd come up to challenge everything. That was Monday. I know I went into the hospital Tuesday, and this is what you looked like. Since then, what the market did is it's knocked on the door and it's trying to extend the rally. In the process, you do have a pattern of higher lows. Actually, I should have put this arrow right here. If we take a look, this low there, here's a low at 3188 and a half. You made a 31.90 and a quarter today. Now, it's an outside day up today. What should not happen? Today's low of 31.90 and a quarter should not be taken out on Tuesday or Wednesday. If it is, it says bull trap, and the market could start a correction. Where to? It wouldn't surprise me if it got back to the 18-day average of closes on that at the 31.49 zone, right in there. Where's the resistance as we climb? The upper Bollinger Band, which has been expanding outward. Notice how it's moving up. Each time you've hit it, you're getting an opportunity to come in at a lower level. When we take a look at the slow stochastics, they're embedded. So until this is lost with the red closing under 80, I think breaks in this market are going to be bought by the pros. They'll come out if they lose the embedded reading, and each time they hit the upper Bollinger Band, I expect them to take money off the table. In the NASDAQ, it is not the same story. You are overbought, not embedded. Embedded's the strongest of signals. You have a market that went into a pattern. If we take a look without today's action, this is how we looked Friday. Lower highs, higher lows. The market was correcting an oversold condition, had lost the embedded reading, never did get to that 18-day average. Often you do that. Making a run towards it, yeah, pat myself, made a run, didn't hit it. Bad boy, Ira, didn't do that. Will we get to the upper Bollinger Band and make a new high, or is it going to go back to the 18-day average to hit it? Even if it hits the 18-day average, the market is telling you the strength of it, because it'll eventually hit it just on its own, but at a higher level than it did back here. That tells you the market is strong, not weak. In the Dow, we have a pattern where the swing line has got lower highs, lower lows pointing down. Overbought market. The market peaked out against the upper Bollinger Band. We're in a corrective measure. What else? Well, when I'm looking at the market here, I see the 200-day average and the 18. If the 18 can close over 26,075, it's another form of a bullish crossover. What about if the market breaks to it? That's the support zone between those two numbers. Is there anything to do here? Well, you're overbought. Everything's not with each other. You've got momentum up, swing line down, and overbought condition. In the Russell, the market's got higher lows, higher highs, right into key resistance. The 200-day average is this gray number, the upper Bollinger Band here, and what bothers me is you're in what I call a pipe. Do you see the Bollinger Band, these black dashed lines? When you're in those, I tell my subscribers, stay away. You think you're going to get a breakout, you get thrown back the other way. It messes with your head. Let the market do its thing. There's nothing I see there. And it's not a trade wreck for you, it's just my observation of the market. Now in the VIX, if this thing will come up, there we are. This is the first time you hit the lower Bollinger Band since back here and here. I think the pros today wrote puts, looking to get back to the 18-day average in that 2730 area. That's what I'm expecting. We'll see if I'm right or wrong from there. They have, when you write a put, the delta changes on you too. It depends which ones they did. So penny for penny, they don't get the play to the downside. On the upside, it'll get very interesting if they get a correction. Big up day on a Monday often leads to a Tuesday break. Keep that in the back of your mind too. In the bond market, momentum has corrected. So we've been coming down for a while and we're flat. Now what the market's really doing is it's decided that the resistance area of the upper Bollinger Band, the black dashed line, and the 18-day average, that quadrant if you will, right here, that half of this, is what the market's trading in. When's the last time we settled under that? You have to go all the way back here to the beginning or middle of June. So the market got over that 18-day average and held it. I'm not a fan of this market one way or the other going into an FOMC meeting next week, but because it's doing this and sideways, I have an upside bias. Trend is up, market is corrected, resistance 180.28. The pros are probably still long. This is too narrow of Bollinger Bands for me to tell any client of mine to have done anything. Resistance, the upper Bollinger Band, support the 18-day average. Let the market break out of that narrowness and then figure out what you want to do with it. In the dollar index, I just remain in the bear camp as this market continues to try to work lower. In the eurocurrency, you know what I'm going to tell you. When you hit the upper Bollinger Band, the pros come out waiting to buy the breaks. Do you have an embedded reading? You cannot count tonight, so let's get rid of that. Both numbers over 80 on the close today, Monday. Same thing Friday, but not that way Thursday. You're just overbought. Let the market decide what it wants to do here. I think pros took money off the table today. I've not heard anything yet with the 27 members of the European Union agreeing at this point as to what is a grant and what's going to be a loan out of all the money that they're going to make available to the southern countries to get their economies going. In the yen, total sideways action. I mean, this is what you call burn and churn yourself, because you're looking for moves to the upside, you don't get them. Now you're looking for the downside, they fail on you. I've learned to leave those tight ranges be. In the Bitcoin, The market's rallied back to resistance, or zone of it, of the 18-day average. The trend has been to the downside. Never did hit the lower band when I was gone, got close. If you get over 94.95, you negate the current downtrend. A lot of sideways action developing in this market. Then the differential between Brent and WTI crude, the market has succeeded in staying over the 18-day moving average of closes, which gives Brent the bid over the WTI. You see that here, but what do you see crystal clear? You should see how tight these Bollinger Bands are. When I see them that tight, I don't even try to analyze the market. I walk away from markets that get that tight. And why? Because you get all kinds of funny signals. You're getting momentum turning down, price over the 18-day average trend up, and how do you break out of those bands? You will. 5% of the time you will, and you will the longer you go sideways, and it'll be a heck of a breakout. Question is which way. Same goes for the gasoline market. I see the overall trend is down, but you're sideways overall. Nat gas back into a bear trend, too oversold in my opinion to do much with. Lower Bollinger Band would be good support, but rallies, I'm going to look for them to be capped in that 178 zone, the 18-day average of closes. I want to remind you, one of the tools during the day that I look at, especially when you get these narrow banding markets, are pivot points. They don't care if the market's banding, they adjust. Now, I created a 3-part video for those of you that like an in and out day trade tool. That's what this is. This is not about position trading in any manner. This is about in and out the same day. I teach you the formula. Then I walk you through and I teach you how to apply this. You're going to learn what these different lines mean, where the support resistance zones are. And then in the third video, I tie in momentum so you have a game plan to work with. The idea is to introduce you to this popular tool. How do you get it? Go to our website. Under free offers, you'll see pivot points and our other offerings. Take advantage. I'm Ira Epstein. You have a good day. I will talk to you all tomorrow.